Welcome back to the Market Insights webinar. This is Kevin Prince from BMO ETFs. We're pleased that each week you take the time to join us and hear some insights in regards towards the market and exchange traded funds more specifically. Our topic this week, a more challenging one, we're going to talk about taxes. And as I do that, of course, I want to bring up the words of disclaimers. You know, we've got to have disclaimers. Disclaimers this week, of course, we're not going to provide you any advice. And we're not going to provide you any specific recommendations. What we really want to provide you, of course, is some insights towards both around the market and around ETFs, with a focus this week on taxes. And let me give you an extra little thing around specific taxes. You know, we're talking about taxes relative towards exchange traded funds. We're going to encourage you, of course, to always seek the advice of professionals when you're looking at taxes across the board. So this is just insights. Please seek the insight of professionals for your taxes too. With that, let's get started. I'm going to introduce my guest, Mark Rays, who's the head of product at BMO Global Asset Management. Thank you for joining us, Mark. You really understand behind the scenes a lot of the moving parts, and that's the parts we're going to talk about today when it comes to exchange traded funds. So thanks for joining us, Mark.
Great, thanks, Kevin, and thanks everyone for listening in this week. I promise we'll do our best to make taxes an interesting topic.
Thank you for that. You know, the first thing we're going to do is we always like to start off with some tools. So one of the tools I'm going to highlight for the audience here is one that we put together. So bear with me. If you're thinking about what to expect during the upcoming tax season, good news. If you're an ETF holder, we've put together an all-encompassing talking document for you to understand the different moving parts across the board. And certainly feel free to share this with your accountant so they can understand some parts too if they're not clear here. Where do you find it? Of course, you got to go to bmoetfs.com to find it. And then if you take a look at any one of our ETFs, you'll see a piece below it called taxes and distributions. That's the tab there. You click on the tab, scroll all the way to the bottom. Just below the word download, if you see it there, there's a FAQ on taxes. You click on that and this document comes up. So it is on our public website, a little bit further harder to find, but look for the FAQ on taxes and you'll find it across the board. But a great source document, and we're using that source document as the key content for today's discussion. With that, now let's get into it. Mark, when we talk about taxes in general, what are those kind of key considerations for investors out there across the board?
Thanks, Kevin. Well, there's really two things to think about that's going to trigger taxation with your ETF holding. Of course, the first and the obvious one that we all think about is when we sell it. So then you're going to have a gain or a loss on selling that ETF. But as well, the ETF itself will give you a tax slip on an annual basis based on what's gone on within that ETF and the distributions that that ETF has paid out. So there may be taxation on an ETF even if you haven't sold your individual position. So just keep that in mind because of the activity that goes on within the ETF itself.
And I do like the note that on the bottom there, don't confuse distribution with performance. I think that's a key thing because ultimately there's a total return that you're getting from the ETF and there's distributions, which can be different over time. Mark, let's first take a little background here with the audience. Now, some of the audience might come from the world where they had a mutual fund in the past and now they have an ETF. Certainly kind of give us some background, what's the differences there, and maybe use the benchmark of stocks and bonds too in that conversation.
Sure, thanks, Kevin. I think what I just want everyone to realize that whether it's an ETF or a mutual fund, they're typically taxed the same way in that they must flow through whatever taxation they receive from their underlying holdings. So if you buy an equity ETF, like our Canadian Equity ZCN, you'll get dividend income because the stocks held within that ETF pay dividends. On the other hand, if you buy something like our aggregate bond ETF, ZAG, you will get interest income because the bonds in that ETF, of course, are paying out interest income over the course of the year. So the ETF is really just a pass-through vehicle for taxation purposes based on what it holds.
Thanks for that, Mark. Good foundation. So then let's dive into those distributions we talked about there a second ago and talk about, you know, they're going to receive distributions and how does that process work a little bit here? We'll dive into a little more detail. Give me some insights here, please, Mark.
Sure, I think lots of good information on this slide. But generally in the new year, you're going to get a tax slip on your taxable accounts anyways, based on the distributions of the ETFs that you own. Of course, if you hold it in a tax deferred plan like an RSP, you won't be getting a tax slip. And what it's doing, again, is passing through the tax characteristics of the holdings within that ETF. And the last note there, just at the bottom, just a little bit of extra detail. Of course, because you buy the ETF on the exchange, you're not buying it directly from us or any other provider. So those tax slips are going to get prepared by your respective broker.
And that's probably a difference between what they normally have in the past, a mutual fund versus an ETF. Where the ETF we treat just like a stock, where they receive the documentation from their respective firm they're working with. And then I'll quickly want to highlight too. We're going to spend today's conversation talking a little more about the distributions and the adjustments around those, of course. But we're not going to dive into the concept of like PFIC and that matter, or into that matter too much for the withholding tax for today's discussion. We're just going to focus more about what to expect during this tax season. Now, Mark, talk to us about the different types of distribution that investors can receive from an ETF.
Sure, there's really two kinds. One would be cash distributions, which you will get over the course of the year. It may pay quarterly, it may pay monthly, but regardless, you're getting cash in hand based on what that portfolio is earning. And then the other kind is at year end is a reinvested and consolidated distribution, which the media likes to call a phantom distribution, because you're not receiving cash, you are getting taxation. And what typically occurs there is your adjusted cost base, or your ACB, will move to reflect that taxation. And those phantom distributions are usually where people trip up a little bit, in that they didn't receive cash, so they're wondering what it is. Just realize you remain invested within that ETF, so you're getting that benefit of compounding and remaining in the markets.
Well, let's dive a little bit more detail into phantoms, because you're right. I think there's some misunderstanding out there. I think we know the ones paid to your hands are pretty straightforward. And the phantom one, that compounding effect they get, because more of the money stays to work versus being paid out, I guess. Let's talk about those phantoms. Now, Mark, give us some even further background when you dive into phantoms, because the audience may want to understand this adjustment cost base. Now, sometimes the firms do it, sometimes they need to do it, but why does that happen? And walk us through that aspect specifically around return, especially around adjustments there and phantoms.
Yeah, and just for everyone listening, I think this is one of the more challenging bits when it comes to understanding taxation. So I'll try to make it as simple as I can. But essentially, you're not receiving cash, but you are getting taxed. So let's say you're getting a capital gains tax slip at year end. Well, because you're paying that tax now, you don't want to pay tax again. So what happens here is your cost basis gets adjusted up to avoid double taxation. So then when you turn around and eventually sell your ETF, because your cost basis is now higher, your theoretical capital gains is reduced. So that way you avoid paying tax twice. And that's a really important factor for people to keep in mind, and really is the backbone of this whole idea of a reinvested consolidated distribution, is that your cost is adjusted so that you don't get hit with double taxation.
And I'll highlight there that some firms do it for clients. Check with your firm if they do this. And then sometimes you may have to adjust the cost base yourself, but again, check with your firm on that. Sorry, Mark, didn't mean to interrupt.
No, go ahead, thanks.
Perfect. Yeah, I mean, that's a key thing to think about, is making sure you don't have to pay your taxes twice, and that's where the adjustment happened. I will note quite often, sometimes the firms too, the adjustment is actually done for registered, non-registered plans too. It doesn't really make make a difference making an adjustment in a registered plan. We all know that, because the taxes really happen when you finally take the money out, of course, right? But in the registered plans, in the non-registered plans, it's all about, avoiding that double taxation, of course. Mark, let's talk about where people can find information about taxation. Now, we're using some BMO examples here, of course, but probably similar stuff at other websites out there. But walk us through where people can find out information on ETFs, specifically taxation.
Sure. Well, of course, the most important thing you're going to receive is your tax slip. So that is what you're going to use to report your taxes. However, if you're looking for information directly from the ETF provider, we do put it up on our website. Most providers will be similar in doing so. So if you went to our website, bmoetfs.com, pulled up the ticker you happen to hold, in this case, the example again is ZCN, or Canadian Equity ETF, you would go to the Tax and Distribution tab, and then you could look at whatever year you wanted to look at. Most obvious would be the prior year, so in this case showing 2020, where it shows all the cash distributions paid. And in the new year, we put out the information down below, which is the sum of the tax characteristics of those distributions that have been paid. And if you want to stick on that idea of a phantom distribution, any non-cash distribution or reinvested distribution will show up in that column to the right of the cash distribution, and is typically included with the December year-end payment.
Thanks, Mark. And good source of information. And I like the fact you can go back over multiple years. And just one more time for the investors out there, if you want that document that helps you understand, you see the tax FAQ, that's the icon you're looking for when you want to pull down that document. Mark, let's talk about those characteristics in more detail of the distribution itself. I'll maybe call the attribution of the distribution. What do people tend to get in an attribution of an ETF? And of course, every ETF is slightly different. So maybe walk us through that.
Sure, and this goes back to what I talked about at the start, Kevin, in that the ETF essentially is a pass-through vehicle for its underlying holdings. So it really depends what type of ETF you bought, if it's equity, or if it's foreign equity, or if it's fixed income, or if it's balanced, etc. So you may get Canadian dividends, you may get capital gains, you may get interest income, and on the next slide, you might get foreign income, or you might get return of capital. And all of those distributions through the ETF are taxed in the exact same way that if you held those securities directly. So in other words, let's say you receive dividend income, you would be able to utilize the dividend tax credit just like you would if you held a stock directly, like BMO or RBC or TD.
And exactly right. I mean, that's good about the Canadian dividends, capital gains, and interest income. Of course, there's international dividends too, which shows more up on your other income aspect. And one quick note on the foreign income and foreign taxes paid. Foreign taxes paid itself, it depends upon if you hold these outside of registered plans, you can use that as and we'll show that later on. That's an offset against other taxes. Let's dive into a little more detail there, Mark. Capital gains, what triggers a capital gain within inside an ETF?
Sure, and like we talked about, of course, it's not only if you sell your ETF yourself, people would recognize and expect to see a capital gain there. It actually occurs within the ETF. So as you can imagine, over time, that portfolio within the ETF is changing. So as it buys and sells the securities within the ETF, it's potentially triggering capital gains. So where could that come from? Well, first of all, you're only going to get gains if things go up. So that's the performance point there. But you could have, a corporate action where a company gets acquired or something gets spun off, which could trigger a taxable event. You could simply have portfolio rebalancing. So an equal weight portfolio might be buying one security and trimming another. A different ETF that maybe is market cap might have new names coming in, or it could have names that fall below the minimum size and liquidity screens, various reasons where you might have portfolio rebalancing. So again, you have to think about this as the activity occurring within the ETF, and that's potentially triggering capital gains for the unit holders.
And of course, and that's what is being distributed in those documents we just mentioned. Mark, now, one thing we should probably talk about here too, we're definitely talking about the context of an ETF, about the adjustments, but other stocks out there, the ETFs are just basically using the same pathway that stocks have been doing. Talk to us a little bit about that if you can.
Sure. So we're looking here at return of capital, and beyond phantom distributions, this is probably the second most common thing that people ask about. And the idea of return of capital is, of course, that you're not getting taxed on that portion of the distribution because essentially it's a return of your invested capital to you. But what you need to keep in mind is that's on a tax basis and not necessarily a cash or return basis. So we've got a good example here of RioCan, which is a large, well-known Canadian REIT. And what the REITs tend to do is they pay out their free cash flow, but from a tax basis, their taxable amounts are actually much lower, typically because they have a lot of depreciation, which is writing off against the other earnings within the REIT. So when they pay out, they are paying out their tax factors, but a significant portion of that ends up being return of capital. It doesn't mean your invested value in the REIT is dropped. It just means you're getting a more tax efficient distribution. So ETFs can be thought of in the same way in most cases. Typically you'll see an ETF pay out what it's earned. In our case, we want to pay out a sustainable yield. But if the ETF is growing quickly, or if there's something like REITs within the ETFs, or maybe some covered calls, different things that have different tax treatment, you may get a more tax effective distribution, which includes return of capital, but doesn't necessarily mean that you're depleting your invested capital. So it just means you're getting less of a tax bill and getting more cash in hand. And so the reason we gave RioCan here as an example is just to really show you that the idea of return of capital isn't something unique to ETFs or even mutual funds. It is something that's actually common out in the marketplace. Thanks, Kevin.
Well, thanks, Mark, and also good to showcase here that the format that ETFs are following here and doing adjustments is really what is already existing in the marketplace. We're not doing anything different. We're just following the same format. And also good to highlight the return of capital, that it's also the same aspect out there in the marketplace, and it could be good rock versus bad rock, as I like to say. Mark, quickly on the before we go to the questions, and I love going to the questions because we have a lot of good tax questions today. Here's a quick sample of a T3 document out here. And the reason why we're showing you that is, Mark mentioned right off the bat some of the, attributions or the aspect of the distribution being paid out. And you'll see all those correspond directly back to your T3, whether it be the return of capital, the foreign non-business tax paid, which could be a credit, your eligible dividends, which of course your Canadian dividends, or your for non-business income, which is just traditional income, and your capital gains. So all that is captured inside your T3, but represent right back to those boxes that Mark was talking about on the BMO ETF website. And of course, on the BMO ETF website, we're showing you, we're doing it by units. This would be specific to you because it'd be based on how many units you hold. Anything you want to add there, Mark?
Just one quick one, Kevin. We're showing a T3 here. That's a statement of trust income. Most ETFs here in Canada are trusts. There are a few out there that are corporations where you would get a T5, but I think for most of us listening in today, the T3 would be the normal tax slip that you would receive.
Thanks, Mark. Now I'm going to keep you on the hot seat because we're going to jump into some questions, and I'm going to thank everyone who's taken the time and effort to send us these questions, because you know what, this actual session today is based upon some of the questions we got in the past. So that's why we decided to put this together. So please continue to send in your questions because it really helps drive our content going forward. Now, Mark, they've heard out there, the audience in general, that ETFs are very tax efficient. Can you explain the advantages of ETFs in regards to comparison to mutual funds or individual stocks?
Sure, there's a few things to think about. First of all, it depends what type of ETF you hold. But generally, if you're holding, an indexed ETF or a rules-based ETF that has lower turnover compared to, let's say, a really active mutual fund, or if you're really active within your individual stock portfolio, you'll generate less capital gains because, of course, therefore you're selling less securities. So that's the first big one. The second is that you're not transacting directly with the ETF. You're buying and selling on the exchange. And that's quite different from a mutual fund where you buy and sell directly from the fund company. So with the ETF, if you happen to sell your ETF, it doesn't necessarily mean that we get a redemption to the ETF. Those units might get, recycled to another buyer on the exchange. So because of that, typically in a non-directional market, there'll be less buying and selling and creation of ETF units, which makes it a little bit more tax efficient that way. Of course, if we do get a directional market, let's say a narrow asset class that a lot of people want to sell out of, that will result in ETF redemptions. But by and large, if the ETF is in a normal market condition, the fact that you're trading on the exchange with another potential unit holder is a key taxation benefit for the ETF. Thanks, Kevin.
Thank you, Mark. Glad to have you on today for that one. Mark, let's keep going on the question here. When you hold an ETF in a taxable account, in a taxable account, there's capital gains compared to other investment types. So how does the capital gains compare to other investment types? And is there any way to minimize tax when investing through ETFs?
Sure, I think this is a question, Kevin, about plan types. So you want to think about, what accounts are taxable, and when you have a taxable account, you want to minimize the income in those accounts. So you're probably thinking there more about equity growth type strategies. In your RSP type account, you might be thinking about some higher income things because, again, you're not paying tax on it. Taxation is going to show up when you exit that plan in retirement. But the one I'm seeing here is the TSFA, so the savings account. So keep in mind your contributions aren't tax deductible, but the income within those savings accounts is not taxed. So you generally see people holding something that's going to produce interest income, look to put those in their TSFAs. So, a fixed income ETF might make sense there depending on your overall portfolio. So it's really a question of thinking about what type and how much income you expect the ETF to spin off versus the taxation of the plan or account that you happen to have available for your ETF holdings.
Thanks, Mark, again. Now, Mark, here's an investor that holds one of our cover call ETFs, ZWB, cover call banks to be specific. Now they're actually holding it in a registered account. So little, we've been talking about taxes, but it's a different, of course, registered plan because they don't have taxes until they finally get out of the investment. Not, it's finally out of the account, not the investment. But what they saw was in April, they saw an adjustment to their cost base, but they didn't receive the cash. So maybe walk us through why that might happen. And it's just a straight adjustment to the cost base across the board. And then, of course, they're not going to get it because it's an adjustment. So walk us through that, please.
Right, so this speaks back to those reinvested or phantom distributions that we talked about a little bit earlier. This is just an exact example of one. So in this case, a dealer's really making adjustment to all accounts, irrespective of what the plan type is, and therefore adjusting the cost base up. And this is significant for the taxable accounts so that there's not double taxation. So in this case, even though you're in a registered plan and you're not worried about getting a tax slip and therefore paying taxes, you're still seeing that adjustment go through as your dealer is adjusting across the board for those ETF reinvested distributions. And as we mentioned, taxable amounts increasing your cost basis. ROC is actually the opposite, return of capital. That's reducing your cost basis. So if you've got taxable amounts on a reinvested, you'll see those increase the cost basis. If you've got return of capital on a cash distribution, you will see your cost basis go down. So sometimes if something's got both a cash distribution and a reinvested distribution, there's a bit of a netting adjustment that's going on. A little bit technical, so sorry for that answer. So it's best to speak to a tax expert there if you want to be able to trace that adjustment through. Thanks, Kevin.
Thank you, Mark. Appreciate that one too. Interesting. Why not taxes just now? So we take a little bit of break. I'm going to come back to tax questions, Mark. But why do hedge index ETFs have rather low daily volume, low liquidity compared to ordinary index ETFs? Have you seen that in your experience there, Mark?
Well, generally, I would say most holders in equities, and this is a big generalization, but most holders prefer unhedged, and on fixed income, most holders prefer hedged. In other words, they don't want that currency volatility in their fixed income. So it depends what you're investing in. But that's the general idea. Of course, there'll be market views on whether, the Canadian dollar is rich or cheap relative to whatever you might be looking at, typically the US dollar, and that might sway things over the short term. But I don't think we should get lost on the low daily volume because, of course, the hedged and the unhedged are really investing in the same portfolio. So they've got the same underlying liquidity. So you may see higher volume on one or the other, and typically that would be on the unhedged, but do know that the underlying portfolio gives the same level of liquidity support to both tickers.
Very good point about the liquidity is really the underlying. Thank you for bringing that up. Kind of take it back into the world of taxes. What are some, generally tax efficient ETFs to buy for a non-registered account in lieu of stocks? Is there a kind of a general aspect of what people should look for?
Well, if you're a general growth investor, and of course then it's going to depend what type of investor you are, you want to minimize that taxable amount. So that's where you want to go after your equity growth, right? So your NASDAQs, your small caps, the portfolios that have lower dividends on them. That's where you want to potentially hold them, is in those taxable accounts. Now, if you're an income-oriented investor and therefore don't really buy growth exposures and tend to buy income exposure, covered calls are certainly an interesting thing to think about there because of the tax efficiency of the call writing. And without getting into the technical details, just know they can sometimes have higher return of capital because the call rating strategies are treated as capital. So we think of those in particular if you're an income-oriented investor. But overall, you just want to minimize the taxable amounts that are coming in if you've got a choice between investing it within your sheltered or your taxable account. Thanks.
Thank you, Mark. And I like to think of those cover calls with that good rock versus bad rock return of capital that is out there, because they're tax efficient making the yield tax efficient. You know, actually, Mark, more market questions. So bouncing back and forth here. Can you explain why tech stocks have really bounded so strongly this week, and maybe give a little market update towards that? And is the response to the stimulus bill that's been recently pushed through? Some thoughts there.
Well, I think first and foremost, the market had been on an exceptional run, and certainly certain segments of the market were looking much more expensive than they had, let's say, a year ago when the economy was in a much more normal position, although we've now actually reached 1 year of dealing with the pandemic. But what you've seen go on in the last few weeks is a real rise in longer term bond yields and having people thinking about inflation. So more growth oriented stocks where maybe more of their cash flows are out in the future get affected by that in terms of their valuation. So we saw a correction kind of coming through. So now this week, you're right, you've got the stimulus bill being announced, which is obviously a positive for markets. But I think you're also just seeing a little bit of a bounce back in that they'd come off so sharply. You just saw a real bounce back in valuation. They're not at the levels they were before this most recent market trend, but certainly a reversion back towards those higher valuations. Thanks.
Thank you, Mark. And I think that takes us to the end of our questions this week. So I had time to get through them. Thank you one more time for everybody taking the time to send us questions. And we do appreciate that because it does help drive the content. Now, what are we going to talk about next week? Because we're going to be back next week, Friday, March 19th at 1 p.m. At that session, we're going to talk about social responsible investing, a very popular topic these days, and certainly driven by some of the smart money out there. We're going to dive into that in more detail. Join us next week at 1 o'clock, Friday, March 19th. Have a good week ahead. Cheers.